各位，在全球人工智能热潮席卷下，亚洲市场呈现出了与美国截然不同的发展路径。摩根大通亚太地区研究负责人詹姆斯指出，中国正在通过芯片自主和反内卷两大政策工具，试图在科技与经济两端同时发力，既稳增长又提效率。这一策略正在悄然改变投资者对中国市场的长期预期。首先是人工智能的战略差异，美国的模式是重武器打击，巨型数据中心、海量算力和尽可能庞大的训练数据集，全力冲击前沿技术。中国只走另外一条路，不是一味追求极限的技能，而是专注于足够好的模型应用，将 AI 直接嵌入了经济生产力的提升。中央政府明确支持本土芯片、自主算法和本地的生态，这种自给自足的战略贯穿了从硬件到软件的全链条。结果是一个具有中国特色的 AI 生态逐渐形成，在资本市场上正吸引着更长期资金的目光。与此同时，政府提出反内卷的策略，正在成为支撑企业利润率的关键变量。过去几年，过度的竞争和产能过剩让众多的行业陷入价格战，利润被不断的压缩，甚至引发了局部的通缩。二季度数据显示，中国整体收入虽增长 6%， 但成本上升导致净利润几乎零增长。7月以来，光伏、多晶硅、汽车、物流等多个领域价格明显回升，显示政策导向正在逐步缓解恶性竞争。反内卷不仅是一个流行词，更是一种试图通过供给侧改革来修复企业盈利、稳定市场预期和经济手段。资金市场的反应已经出现了，香港股市的活跃度空前，来自内地的科技企业加速在港融资上市，港股通资金南下日度不减，打破了香港退市论的悲观预言。摩根大通认为，这一趋势不仅意味着科技公司融资环境的改善，更标志着国际资金重新评估中国资产的价值。展望下半年，中国宏观经济面临的最大挑战依然是平衡，既要通过科技自主和产业升级推动增长，又要应对全球债务高企带来的潜在通胀压力。萨利文提醒，全球各国因疫情刺激积累了巨额的赤字，政府普遍有用通胀化解债务的动机，这对亚洲来说，尤其是新兴市场，构成了长期的风险。但在他看来，中国正在通过稳企业利润、促产业升级的组合拳，为资本市场提供了一个更可预期的环境。对于投资者而言，这意味着一方面高端制造、AI 供应链和自主芯片等结构性赛道值得长期配置，另外一方面，受益于反内卷的传统行业，如物流、材料和高股息的价值股，同样具备防御性和回报潜力。换一句话说，中国的机会正在从单一的科技概念扩散到更广阔的经济版图。全球的视觉下，詹姆斯·塞利文给出的结论非常清晰：美国 AI 股价或许因溢价过高而趋于中性，但亚洲，特别是中国，正在以芯片自主和反内卷的双轮驱动，打开新一轮增长的想象空间。让我们看一下视频。
The AI play in Asia, we're suddenly seeing that in China, and we're seeing a red hot market right there.
And you're very clearly seeing support from the central government for independence or self-sufficiency in that space, and that really goes across the entirety of the ecosystem. I think one of the very clear differences that we see in China and several other Asian nations relative to the strategies that are being deployed in the US is all about massive data centers, massive power infrastructure, and the largest amount of training data sets possible, massive amounts of chips deployed in those data centers. China in particular has taken a slightly different approach, and instead of bleeding edge, has really focused on implementing good enough models and driving productivity in the economy today. And so we are seeing slightly different approaches. Both require investment, and the support that we're seeing from the central government into that space across the China-defined ecosystem, separate and distinct from the U.S.-defined ecosystem, as you very rightly say, has driven performance, and we think will continue to moving forward. Particularly relative to the view on the China equity market in general, is this anti-involution, horrible term, but very significant impact on markets. The key takeaway from the second quarter earnings print was reasonable top-line growth absolutely swamped by margin compression. Since July, we've seen a very, very meaningful turn in the macro statistics coming out of the Chinese economy, sector by sector by sector, and we do think that that will also support market performance in China as we look into the second half.
So in terms of earnings, because that's one gauge that people are looking at, how much clarity, how much confidence is there in terms of earnings in Chinese companies? If you take a look at the Q2 numbers, I mean, top line was 6% growth, but if you take a look at the other fine print, you may not be that confident.
And it's important to recognize and look at the high-frequency data. And so as you very rightly say, 6% top-line growth, you saw a very significant increase in costs, which led to effectively zero bottom-line growth. If you go industry by industry, however, you're starting to see significantly better polysilicon pricing from July. You're seeing significantly less auto discounting. You're seeing logistics ASPs up 9% since July. And so really across the board on a multi-sector basis, we're seeing very real impact from the Chinese government's focus on this anti-involution concept, which is effectively saying we have oversupply in a lot of industries. That's driven severe cost competition. That's driving deflation for the overall Chinese economy, which is obviously not good from a macroeconomic perspective, but it's also destroying margins across the various sectors that we look at. From July, those statistics have significantly changed. That's driving outperformance in China, and we think that that will continue.
It is a positive market environment, and Alibaba obviously tapping the market to fundraise. I'm just wondering if you see other big tech companies doing the same. Is this a great opportunity for them to do that?
So, as Linda, the obvious answer would be the absolute explosion of activity that you're seeing in the Hong Kong equity markets. You're seeing significant fundraising across the board, primarily from mainland Chinese companies coming back to Hong Kong. It's interesting because you did have a lot of prognosticators, to some degree, calling Hong Kong out of the game. That's clearly not been the case, as you've seen this resurgence of mainland Chinese listings through the HKEX and other listings in Hong Kong.
So what's the outlook? How do you play it? How best to position?
So we're still very positive on emerging markets in general. Here in Asia, we continue to be overweight India. We're positive here in Japan. We see select industry plays in China after a period of outperformance. Really, the critical thing that we're looking at on the other side of the equation, however, are significant baked-in structural inflationary pressures across the board in many markets. You have very significant government debt levels coming out of the COVID stimulus packages. Paired with that, you see rising deficit spending in a lot of economies. And so we have to recognize that governments are incented to run inflation hot to try to inflate away these very large debt piles that we have. To the degree that that results in political pressure on central banks, not just here in Asia, but increasingly in developed markets, that could result in an asymmetric risk where inflation runs hot for an extended period of time. And that's really something that we're trying to watch very closely.
You just mentioned India. You're liking that economy, that market really well. How much of that has to do with that GST tax cuts that's just been announced?
It definitely matters. I would argue that you've seen a series of government efforts over the course of the last couple of months to ease the burden on the consumer. And one of the key elements that we're watching in the India market is this potential for a significant inflection point, particularly for rural consumption across the Indian market. We have to play India somewhat selectively, given the high valuations there. And so from a sector by sector perspective, we are trying to be pretty specific. If we look across the rest of the major markets in Asia, it's a somewhat similar story. In China, we're far more leaning into materials and industrials on the anti-involution trade rather than a broad view on the market as a whole.
I want to look forward, James, a colleague of mine just talked about this 52-week high club for the U.S., and we have Alphabet, Broadcom, Micron, and for the 52-week low club, it's consumption plays at the bottom, Colgate, Dr. Pepper. If you take a look at the next 52 weeks, what would your bets be?
Look, the critical component of the view on the U.S. is really this concentration of performance among a very limited number of artificial intelligence-related stocks. As a result of that outperformance, you have a U.S. market that's trading at over 22 times earnings. That's at decades-long record levels of premium relative to the rest of the world. To put that mathematically, you're sitting at a 95 to 97th percent level relative to the rest of the world. And so that really drives our neutral view on the U.S. and the overweight that we have on emerging markets. Within the U.S., we are looking at the potential risks of rising tariff pass-through, which is resulting in this weakness in the consumer-related spending stocks, as you very rightly highlighted. The critical component here is really going to be corporates putting numbers to productivity gains being driven by AI. We've seen a couple of scares in the marketplace on a year-to-date basis. We need to see more solid evidence that AI is driving productivity gains and margin upside across broader corporate America. We don't have proof of that yet. We have significant hope, and that's embodied in the 22.5 times earnings that's applied to the U.S. market right now.
James, always great to have you on the show. James Sullivan, head of Asia Pacific Equity Research at JP Morgan.